and earnings season is in full gear. The equities market, with a number of them already churned out their half-year results, while some posted dismal figures reflective of the impact of the COVID-19 pandemic. Others, particularly those from the cement sector, managed to post firm results irrespective of those effects of the pandemic. In our next conversation, we will be looking at the results of the two cement giants, Dangote Cement and Lafarge Wapco. And joining us now to analyze these results is the head of portfolio management at Comercio Partners Asset Management, Victor Aluyi. Good morning, Victor. Thank you for joining us.
Morning. Thank you for having me.
So let's start with Dangote Cement. Are you surprised at the year-on-year growth in revenue and the other key lines, despite the COVID-19 lockdown, that saw the restrictions on movement across markets in Africa?
No, I'm not surprised. I think it's a result that I would describe as largely resilient in spite of the COVID-19 challenge. For context, group revenue rose by just 2%, so about 476 billion. However, if you dimension that result, you would see that the Nigerian arm of the business essentially constituted, the major drag. Revenue in Nigeria was up by just 1.2% to 332 billion, while Pan-African revenue, that's revenue from its other African, businesses, rose by about 3.5% to 145 billion. It's also important to point out here that, revenue from Nigeria accounts for about 61% of total group revenue, while revenue from its Pan-African business, that's its other African businesses, accounts for about 39% of total group revenue. It's also important to mention here that Dangote Cement has African subsidiaries across about 9 African countries. So it has a really strong Pan-African footing. If you also look at volume growth, which also directly speaks to, the sort of revenue growth that we have seen, volume growth across the group declined by about 1.5% to about 12.1 million metric tons. If you look at the volumes for Nigeria, that dropped by about 2.4% to 7.4 million metric tons. Pan-African volumes grew slightly, 0.7% to about 4.7 million metric tons. In terms of volume growth, again, Nigeria accounts for about 69% of that, while the Pan-African business accounts for about 31%. So across board, you're seeing very resilient results. As a matter of fact, you're seeing significant traction on that Pan-African front, whilst, of course, Nigeria was the major drag, if you will. And that's quite understandable, because of the COVID-19 challenge. And also the half year, which is typically heralded by the rainy season, is typically a slow period for the cement manufacturers as well. But all in all, I think the result is quite resilient.
Now, but what do you think the company may have done differently to record such success in that second quarter?
Well, I think that it's market share, it's dominant presence in other African countries, because like I pointed out, if it was not for the growth that we saw coming through from its Pan-African business, in spite of the fact that it just contributes about 30% to the group number, it was able to pretty much assuage the impact of the drag that we saw in Nigeria. Remember that Nigeria was on substantial lockdown, movements was restricted, so that clearly reflects the fact that, the growth that is seen on that Pan-African front is helping to really assuage, that impact on the Nigerian front.
Now, part of the drags for the company is the general increase in salaries, which also pushed the Nigerian manufacturing costs upwards relative to half-year 2019. Materials consumed, for example, increased by about 6% year-on-year. And what do you make of such development?
Well, I mean, it's reflective of the times, really. These are costs that, they have to sort of bear with every now and then. But I think I would look to the sort of growth that we're seeing, in that top line. I would also look to the sort of expansion we're seeing in that Pan-African business. It's also important to look at, some of the dynamics within its balance sheet and see how, the business continues to move and continues to grow going forward. If you look at the EBITDA for Danksem, that came in flat at about 218 billion. But again, if you further dimension, you will see that EBITDA from Nigeria was down about 3.1%, while the EBITDA from the Pan-African business grew about 31%. So I think that, that Pan-African business seems to be a bright spot, if you will. But it's also important to know that we're going to see some significant recovery on that Nigerian front as lockdowns have been eased, as we have seen movements, interstate movement that have been also eased. That should significantly ramp up volume for the Nigerian business. So I think that, the second half of the business should even be much better than what we have seen from that challenged first half.
How optimistic are you, about the commencement of the Apapa and OnAir export terminals? Do you see such moves helping to mitigate the impacts of the land border closure in the second half of the year?
Absolutely. I mean, that's the strategy. The land border closure has been a drag, really, particularly for its, West African business. Nigeria has deposits of really good limestone, which you don't have in other West African countries. So it forms a major hub through which quality cements can be pushed out into the rest of West Africa. But unfortunately, the land border closure has been a major restriction on that. So the opening of the Apapa export terminal and also the OnAir port as well would significantly improve that situation. As a matter of fact, that export has already started. About 26,000 tons of clinker was exported over the last couple of months. And we would see that also ramp up quite significantly towards the end of the year. So yes, that's a very, very positive development for Dangote Cements.
All right, let's look at Lafarge Wapco. Do you get any sense of resilience in the second quarter results, given the earnings before interest and taxes growth of about 29.7% compared to the previous year?
I think for Lafarge, the sort of growth that we've seen in revenue is quite encouraging, about 2.3%, which is also largely in line with what we're seeing for Dangote Cement. But I think the story for Lafarge is essentially around its the deleveraging of its balance sheets and also the hiving off of the South African business. That has significantly optimized and improved the balance sheet position of the business, its financial position as well. So we see revenue increasing by about 2.3% to 120 billion. However, if you look at that on a quarter-on-quarter, that's in quarter two, for instance, revenue was down by about 5.1%. Again, that essentially points to the whole COVID-19 challenge around the restriction of movements. Like I said earlier, the beginning of Q2 usually heralds the rainy season, which is typically a slow period for cement manufacturers. We've seen margin expansion, we've seen finance costs drop quite significantly, and that has also boosted bottom line for Lafarge. For context, what they have in terms of half year profit after tax about 28 billion is higher than the entire profit that they got for last year. So clearly you are seeing significant improvement for Lafarge. You are seeing resilient growth in top line, but I think that balance sheet deleveraging will prove very, very critical in ensuring that they are able to sustain this sort of performance going forward.
Now, what do you make of the fall in net sales of Lafarge by about minus 5.1%?
Well, I think, like I said, it's clearly reflective of, the seasonality and also equally importantly, the whole COVID-19 challenge. We had significant interstate lockdown for about a month plus. Movement was restricted. So it obviously affected its, route to markets. But as that has been eased now, it should, significantly improve, going forward. So I think that's a one-off, reduction that we're seeing. Going into the rest of the year, I think we're going to see significant improvement on that front.
Our Lafarge Africa seems to have a relatively low finance costs in the second quarter compared to the corresponding quarter in 2019. How will you score the management in this regard, considering the 67% year-on-year drop this period and the fact that all through 2019, finance costs kept growing quarterly from about an 8.32 billion naira in first quarter of 2019 to 20.18 billion naira in the fourth quarter?
So like I said, so the story for Lafarge really has been that balance sheet deleveraging. They've had very significant challenges, particularly with respect to finance costs. What they have done basically is to sale of the South African business, and also significantly reduce the debt on their balance sheets. And that is beginning to show. The reason you saw those significant increase in finance costs through 2019 was, the challenge was still there and they were essentially trying to deal with it. But you're beginning to see the result of the fact that they have dealt with that, and you're seeing finance costs drop significantly. We expect that to actually continue because that would obviously give the company, significant leeway to continue to improve its bottom line, because that finance cost element is almost essentially out of the picture, really.
Now, Nigeria's cement consumption in the second quarter turned out better than expected, despite the low volumes recorded in sales. But would you say the decline in volume is as a result of the growing competition within the cement industry or due to the lockdown effects?
I think it's a combination of factors, but I would say that, the lockdown effect is quite significant. It's a significant portion of that. There are essentially three major cement producers in Nigeria today, and they all have their, if you will, niche market, and they're all doing well in those various markets. So the sort of results that we're seeing for Lafarge and also Dangote Cement is clearly reflective of what's going on in the industry in terms of the COVID-19 challenge, as well as, the slowdown, the seasonality in terms of slowing down, particularly during the rainy season. So I think it's a combination of factors, really.
Now, the government's capital projects for the second half of the year are in the works, and one would literally expect Lafarge to benefit from this. But how healthy is the competition among the dominant players? We have Dangote, we have Bua, and of course, Lafarge, in the space, given these projects' demands.
Well, I think Dangote Cement is by far the biggest player, and of course they are poised to obviously benefit the most. But I think that with the capital expenditure being executed by government, most certainly all of the cement players would benefit. But also it's important to point out the fact that you have a lot of real estate projects going on, particularly in the southwest, where you have Lafarge having a really strong presence. But again, I think that their market share would play a key role. So obviously Dangote Cement would be the biggest winner. For a player like Bua Cement, we're seeing capacity increase quite rapidly over the last year plus. That would also put them in a good position to adequately compete. So obviously with these three players, that could also be good for the final consumer. But again, because of the deficit that we're seeing in infrastructure, the demand really remains really strong and resilient. So clearly, these players are poised to benefit quite significantly from that capital expenditure implementation of the federal government.
So generally, what is your outlook for that sector?
Well, I mean, going into the rest of the year, I think we're going to see a better performance. I believe that the worst of the COVID-19 challenge is behind us. I also believe that towards the end of Q3, going into Q4, the seasonal impact of the rainy season will start to reduce. So we should see, a decent pickup in volume. So for I believe that the second half of the year will be much better than the first half, on the back of the fact that the worst of the COVID-19 challenge is behind us, and also the seasonality impact would have significantly reduced. So I believe that going forward into the rest of the year, we're likely to see even better performance for Dangote Cement. We're likely to see even improved performance on the Pan-African front. For Lafarge, the balance sheet deleveraging will continue to, provide great succor for that bottom line. And for Bua, I think that the increase in its capacity and also the ramping up of its capacity utilization will continue to bode well for it. So I think we'll see a better second half than the first half that we have seen.
All right, thank you very much for your time, Victor. Victor Aluyi is the head of portfolio management at Comercio Partners Asset Management.